All right, let's jump right in. Today, we're going to explore the world of commercial trusts, but more specifically, we're talking about a huge moment in tax law that basically created a great divide, splitting these investment vehicles down two very, very different paths. It's really a story about how one big rule change completely reshaped the way businesses could be structured and, just as importantly, how investors get paid.
Just so you know, this explainer was prepared by Dr. Samir Al-Rashani, with some AI support.
So here's our roadmap. We'll start with why these trusts were so popular to begin with. Then we'll get into the big tax transformation that created something called a SIFT. After that, we'll walk through a real-world example to see how the numbers work, look at the one major exception to the rule, REITs, and then we'll wrap it all up with the key things you, as an investor, should take away from all this.
Okay, let's dive in. To really get a handle on where things stand today, we have to go back in time a little bit. We need to understand why income trusts were, for a long time, such a powerful and often preferred alternative to your standard corporate structure.
So what are we even talking about here? Well, at a basic level, commercial trusts are a type of inter vivos trust. It's a fancy legal term, but all it means is it's a legal setup where a trustee manages assets for a group of beneficiaries. You're probably familiar with things like mutual funds, and for our purposes today, the key example is the income trust, which was specifically designed to operate an active business.
Now, this is where it gets really interesting, because this slide perfectly illustrates the one big problem that trusts were built to solve. On the left, you've got a typical corporation. The corporation makes a profit, and it pays tax on that profit. Then, when it distributes what's left to shareholders as dividends, the shareholders have to pay tax on that money again. It's a classic case of double taxation. But look at the trust structure on the right. It completely sidestepped this. The income simply flowed through the trust, directly to the beneficiaries. The trust itself paid nothing, and the beneficiaries paid the tax. The key takeaway? The income was only taxed once.
And this flow-through system was a huge deal for a couple of reasons. First, as we said, the trust itself paid no tax. The tax bill was passed straight on to the investors or unit holders. But second, and this is crucial, the income kept its original character. What does that mean? Well, if the trust earned things like capital gains or certain dividends, which often have preferential tax treatment, that favorable treatment was also passed right along to the investor. You can see why it was such an incredibly efficient model.
But, as you might have guessed, this incredibly efficient system didn't fly under the radar forever. In 2006, the entire investment landscape was redrawn. The government brought in a whole new set of rules that took direct aim at the very tax advantages that made these income trusts so popular in the first place.
And this timeline shows you the exact moment the music stopped. Before Halloween of 2006, pretty much all income trusts worked under that great flow-through model we just talked about. But for any new investment or royalty trusts created after that date, everything changed. They were pushed into a brand new category and hit with a completely different corporate-like tax regime. And this new category was called a Specified Investment Flow-Through, or SIFT for short. Now, this label was applied specifically to publicly traded investment trusts, the ones operating an active business, and also to royalty trusts, which you see a lot in the oil and gas sector. The entire point of this new SIFT designation was to make these trusts look and act a lot more like corporations, at least when it came to paying taxes.
So how exactly did the government pull this off? Well, you could think of it as a three-punch combo. First, they took away the SIFT's main superpower, its ability to deduct the income it paid out to its investors. This meant the income was now trapped and taxable inside the trust. Second, the trust itself now had to pay a special tax on that income. And finally, whatever money was left over for the beneficiaries was no longer treated as flow-through income. It was now automatically relabeled as an eligible dividend. Just like that, the flow-through advantage was gone.
And that special tax wasn't just a slap on the wrist. We're talking about a combined 25%. That's a 15% federal rate, plus another 10% that was meant to stand in for provincial tax. Now, that number wasn't picked out of a hat. The whole point was to make it very similar to the general tax rate for corporations. It was all about leveling the playing field and getting rid of that structural tax advantage the trusts used to have.
Okay, that's the theory, but what does this actually look like for an investor's bottom line? Because honestly, the numbers really tell the story here. So let's walk through a practical example together.
Let's frame this with a really simple question. Imagine a SIFT earns $1,000. After all the dust settles, after both the trust and the investor have paid their share of taxes, how much of that original $1,000 is actually left in the investor's pocket?
Okay, let's break this down line by line. The trust starts with $1,000 in income. Right off the top, it pays that 25% SIFT tax, which is $250. That leaves $750 to be distributed to our beneficiary. Now let's assume this beneficiary is in a 45% personal tax bracket. They receive that $750, but it's now treated as an eligible dividend. The tax on that is about 28%, or $210. So what's the final take-home amount? Just $540.
And here's where you see the total impact. The trust paid $250 in tax, and the beneficiary paid another $210. Add that up, and you get $460 in total taxes on that original $1,000 of income. That's an effective combined tax rate of 46%, which is almost identical to our investors' top marginal rate of 45%. The single tax advantage? Poof, it's been completely wiped out.
And this leads us to a pretty blunt conclusion, as the source material puts it. The end result of all these changes is that there is now little, if any, real tax benefit to using an investment trust or a royalty trust to structure a business. The new rules effectively force a corporate-style tax outcome, which makes the whole structure way less attractive than it used to be.
But, and this is a really big but, the story doesn't end there. When these new SIFT rules were being written, one very important type of commercial trust was specifically left out. So let's turn our attention now to the major exception, the Real Estate Investment Trust, or REIT. And the law here is crystal clear. REITs are not considered SIFT entities, period. And what that means is they were allowed to just keep on operating as normal flow-through trusts, holding on to all of those powerful tax benefits that the investment and royalty trusts had just lost.
So what's the secret sauce for REITs? Well, a lot of their tax efficiency comes down to a concept called capital cost allowance, or CCA. Basically, this is a tax deduction for the wear and tear or depreciation of their assets, in this case, their buildings. The magic here is that it's a non-cash expense. It reduces the REIT's taxable income without actually reducing the amount of cash it has on hand to pay out to investors.
So look at how this all comes together for a REIT. Just like the old trusts, its net rental income flows right through to investors, and the trust itself pays zero tax. But then it gets to claim CCA, which acts as a powerful tax shelter. This often leads to a situation where the cash distributions a REIT pays out are much higher than its taxable income. And that extra portion paid to an investor? It's considered a return of capital, which is, amazingly, tax-free.
All right, let's bring this all together and look at the final scorecard. After that great divide in 2006, investors looking at commercial trusts are really facing two very different paths. Let's summarize the bottom line for each one.
This slide really says it all, doesn't it? For a SIFT, you've got tax at the trust level and then tax again at the beneficiary level. The net result is a corporate-style double taxation system. But for a REIT, there is no tax at the trust level. The income flows through to the beneficiary, which means you're back to a single tier of tax, and even that is often reduced or deferred because of things like that return of capital we just talked about.
And that leaves us with one final central question to think about. When it comes to structuring a modern business, which of these two paths really provides the greatest tax efficiency? Is it the corporation-like SIFT, or is it the classic flow-through REIT? As we've seen, the answer depends almost entirely on one thing, whether that business is in real estate or if it's in something else.